Hello, everyone, and thank you for joining us on this special Tuesday broadcast. We usually have our free webinars on a Wednesday, but because of the holiday tomorrow, I am bringing you this brief educational video where today we're going to be talking about 3 exit strategies that will change the way you trade. Most students we have, a lot of times they don't have a strategy that doesn't meet their needs. The strategy works fine and feel comfortable. It's more about the exiting that really gets them in trouble. So today we're going to share with you 3 that I feel will really change the way you trade and will take your trading to the next level. For example, we take a look at this chart here in FANG. Most traders would look at this right off the bat and say, well, Steve, no real direction going on here, going up, going down, going back up again. Don't really know where I'd get in or where I'd get out. But let's say you just assumed that you bought here thinking there was a breakout to the upside, okay? Well, what we're going to be sharing with you today is after you have a nice little profit, right here at these levels, you see that all of a sudden the trend changed. So this is what happens a lot with so many traders. They'll be doing really well, and right at the levels where they feel comfortable and they have a really nice profit, all of a sudden things go the opposite way. Well, one of the methods I'll be teaching you today actually generated an exit signal right near or at the very top of that upward trend. And you could have exited with a nice 25-point gain before the market decided to turn and go the opposite direction. So this is what we're going to be sharing with you today, our special holiday presentation. It's 3 exit strategies that will change the way you trade. So welcome, my name is Steven Primo, President and Founder of Specialist Trading. And this is our, as I said earlier, our special Christmas Eve presentation because of the holiday. And this is my gift to you for the holidays because you can start using these exit methods as early as, I guess, not Wednesday, but Thursday, once we come back to trading. I really think they will heighten or elevate your trading, and you'll be able to be more comfortable with your trading method. Now, before we begin, we're required to share this with you, so please take a moment to view our disclaimer. I'm going to show you these 3 exit methods in just a few seconds, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now, this will be a brief presentation today, but if you'd like to get more education on a daily basis, you can follow us on Twitter or X, however you'd like to call it. You can also subscribe to us on YouTube, see a lot more of this content on YouTube. So great ways to get more education, more videos, and more content. Either follow us on Twitter with our handle right there, or X, however you'd like to name it, or subscribe to us on YouTube. Click the subscribe button and you'll see a lot more of our content. Now remember, as an educator, we're here to teach you how to trade. I know a lot of webinars you may have attended or a lot of courses you may have attended. You're basically not doing anything on your own. You're waiting for someone to tell you what to buy or what to sell. But as an educator, we encourage you to make those own decisions. Why? Because a good mentor does not trade for you. He does not tell you where to buy, where to sell. He simply provides the information so that you can make those decisions. So my goal is not to force feed signals down your throat and tell you what to do on a daily basis, but it's to teach you how to trade with the specialist edge. When I was first trading some 47 years ago, that's the way I learned from my mentors. These were specialists on the floor of the trading floor of the exchange. And this is what has sustained me now for this amount of time. So hopefully it will be able to do the same for you. Okay, with that stated, let's begin. And we're going to start out by talking about today's theme. And this is something my mentors taught me when I first started, and that's this. Having an exit strategy can avoid unnecessary pain. Because what is the worst feeling in the world as a trader? I know a lot of you are wondering what it is, but the worst feeling in the world is not a loss, simply losing. The worst feeling in the world is having a profit turn into a loss. It's the worst feeling because for a moment there, you were thinking of all the things you were going to do to spend that money, of how well you were doing, all the confidence it was giving you, and then it turns into a loss or unnecessary pain. This is where a really, I would say, consistent exit strategy can help you. Now, it doesn't guarantee that you will never have a loss again, but you're able to go through this with and avoiding a lot of unnecessary pain. So this is what we're going to be sharing with you today. And there are 2 main types of exits. I know a lot of people say, well, how can there be 2 main types of exits? You just get out, right? Well, no, there are 2 different ways, 2 different categories. All right, so let's go through what they are. The first one is a fixed exit. So this means that even before you get into the trade, you know exactly where you're going to be getting out. Usually you'll have a limit there, or you have an idea in your mind that if it gets to this price, if it gets to this point, I'm exiting. That's fixed. That means it doesn't change. It's just, guaranteed that you're going to be getting out if you have a profit. Now, the other type is obviously the opposite. It's called a dynamic exit. Now, what this type of exit does is it moves with the ebb and flow of the market. So you don't really know where you're getting out once you initiate the trade. You're basically letting the market tell you when to get out. Now, with a fixed exit, you know exactly what your profit or loss is going to be. With a dynamic exit, you don't. But this can have also positive effects as well, because if a market tends to go straight up the way we've seen today, the market has just gone up and an air market went straight up. If you had a fixed or exit, you would have been out probably at a limit and taken your profits and said thanks. But if you had a more dynamic exit, staying in the market much longer, you would have been able to reap more profit. So there's no right or wrong. One is not better than the other. What makes the right or wrong is when you're trading out of sync with who you are. If you're the type of person that likes fixed exits, you want to know where you're getting out prior to even entering, well, then choose that category. If you're the type of person that says, I feel comfortable following the market and letting the market tell me what to do, well, then great. Follow a dynamic style of exit. That's where the right or wrong comes in, when you're out of sync with what makes you feel comfortable. All right, so let's talk about our first strategy. This is exit strategy number 1, and it's called the previous high, previous low. All right, so what does this really mean? Well, I have seen over the years of trading that a previous high, in other words, a short-term high, doesn't mean the most extreme high of a stock or a market, futures, currency pair, but the last most recent high acts almost like a magnet. Price tends to pull back and gravitate towards that previous high if you're long, if it's an upward momentum in the market. Now, if the momentum or trending is down, and a price makes a low and then bounces, well, then price tends to gravitate towards that low again. It will always test itself to see if it's going to touch that previous low or that previous high. So this we can use to our advantage as an exit point. Let me show you what I mean here. Now, get used to this chart, by the way, Fang, because I'm going to show you in all instances how you can apply these 3 exiting strategies using the same chart. Okay, so let's say we're trading this or we're watching this, and we see that it's gone up here and it's doing quite well. And then all of a sudden, we decide to go short, because what do we have here? Let's say we're a student of pattern of candlestick patterns, and this is a bearish engulfing pattern. So you say to yourself, okay, this is a sell signal for me, not sell signal meaning I'm exiting my trade. I'm initiating a trade based off this. So you decide to sell. Now, what we want to do using this exit pattern is to find the most previous low, and that was right here. So if we sold, there's a tendency that price is going to come down here and test this. So what you could do is place your limit exactly at that low, the same price as the low, maybe a little bit above that or a little bit below it, but somewhere around this previous low, because price, as I said, tends to gravitate. So look what happened after that. It came right down to that point and then decided to bounce back up. Do you see how that works? So this is a great way to automatically know where you're getting out with a fixed exit. And once again, how you decide is up to you. If you want to put it at that exact same low, you want to put it a little bit below or a little bit above, it's entirely up to you. All right, so we're following the trade. We have a nice trade there. And let's say we decide to buy right here at this point. All right, so using the same exit strategy, where will we get out? Well, this time we're looking at the most recent high, which would be right here. This is the previous high. So we can decide for ourselves with a fixed exit if we want to even get into the trade, because if it's not worth our while, if it's too much risk to be waiting to go up a little point, we won't want to take it. But we can also decide to take the trade. This is one of the advantages of using a fixed exit. So if the exit is not enough profit for you, then you don't take the trade. But let's say we decided that this is enough, so we'll place an order to exit right here, and we get into the trade on the close, and let's track it. 1, 2, in 3 days, we got right there again. So we exited with another profit. Once again, you could either put it a little bit above or a little bit below or right on the exact high. It makes no difference. It's entirely up to you. This is where we want you to become a part of the process and decide for yourself. Now, one of the things about a previous high or a previous low, it does not guarantee that you're going to stop exactly right there, the way we did in the first example. We came exactly to that previous low and then bounced. All it states is that most likely price is going to gravitate in that direction. It's going to be pulled like a magnet. Now, sometimes it will stop right here, and other times it will keep going. Okay, so you have to know that going in. But if you look back in hindsight and you say to yourself, well, gosh, why did I get out? I could have captured so much more gains, but then look what happened after that. Okay. Now, about a month later, you would have looked back and said, boy, I'm glad I got out here because I would have avoided all this unnecessary pain. So this is exit strategy number one. Let's review it. This is a fixed exit. And what we're doing, if we are long, if we purchased a stock, a future, a currency pair, it makes no difference. We're going to exit at the most recent short-term high. Now, if we got short, if we purchased puts, what we're going to do is we are going to exit at the most recent short-term low. This is a fixed exit, and this was exit strategy number one. Let's move on now to exit strategy number two, and this is applying the 5-period simple moving average. Okay, so how does this work? Well, once again, let's say we're looking at our old friend here, FANG, F-A-N-G. We decided to buy right here, okay? What you want to do once you've initiated the trade is you want to apply a 5-period simple moving average, right? Now, you can experiment with other time levels of moving average. You can experiment with other types of moving average, a weighted or exponential. I have just found that over the years, this works the best with a simple 5-period simple moving average. And the way this works is that once you're in the trade and you apply the 5-period moving average, regardless of what market, regardless of time frame, you will stay in the trade as long as price does not close below that 5-period moving average. Now, it may close on the next bar before that 5-period moving average, so you get out, okay? Or else you may stay in for days, weeks, even months. So this is what we mean by a dynamic exit, where the market is telling you when to get out. So let's track this and see how it worked using exit strategy number two. Well, we're still in the trade and it's working nicely. We're above. And remember, we don't have to have the entire bar above the way it is right here. We're just concerned with where the close is, okay? If it closes below, even though the majority of the bar may be above the 5-period, that's okay. But if it closes below, well, then that's our exit point. So let's continue to watch. It continues to go higher. Now, if we used our standard exit here, we would have been out, but according to this plan now, we're still in, and we're still in, so we're able to capture some more profits. It's still going in our direction, even though we closed lower. Still in our direction, we're still doing all right, but it's getting closer to the 5-period moving average. Now look what happened. We opened below, traded below, but where did we close? We closed above the 5-period moving average, so this is not an exit signal. We're not going to exit at all. We're still in the trade. And we're still in the trade, even though we're touching. We're still in the trade. And it's good news that we're still in the trade because look at it's continuing to go higher and higher. Now, at this point, all of a sudden, we have another down day. And then right here, we're getting very close to, we're still closing just a little bit above that 5-period moving average. But at this point, on the very next bar, we closed below it. So you have two options now. You can trade this strategy, this exit strategy, either aggressively or conservatively. If you're an aggressive trader, if you see it close the way it did right here, you'll just exit at the market on the close. A couple of minutes before the close, just say, I'm out. Take your profit and say, that's great. I had a nice profit and I let the market tell me when to get out. If you're a more conservative trader, what you'll do is you'll say, I will exit once it closes, or I'm sorry, not closes, once it trades below the low of this bar that closed, okay? So you're still in the trade. So that's the initial exit, the aggressive exit, and the more conservative would be right here. So let's see what happened. Let's say we use the aggressive exit. Well, we would have got out at a better price. If we use the conservative exit, we got out in the opening here. But either way, we're out. If we traded aggressively or conservatively, we're out of this trade altogether. We have a profit. And we would have exited here using the conservative method. Either way, we would have avoided that large move to the downside. So this is using exit strategy number two. We captured more gains than exit strategy number one. And you have two options. You can either trade it aggressively or conservatively. So let's review. This is a dynamic exit, as you just saw. Why? Because the market is telling us when to get out. We're not putting a exact limit, and saying, well, I know exactly where I'm getting out. We don't know where we're getting out. So you have to decide which one makes you feel more comfortable while you're in a trade. Now, if you're long, you're going to exit on the first price bar that closes below the 5-period simple moving average. If you want to trade that aggressively, that's the way you'll trade this. You'll exit on the first bar that closes below the 5-period simple moving average. If you're trading it conservatively, you'll wait for price to trade below that bar, okay? Now, if you're short, if you buy puts, whatever you're looking at, you'll exit on the first price bar that closes above the 5-period simple moving average. So in other words, if you're short, price is going down, and that first price bar that closes above the 5-period moving average, you get out at the market. Obviously, if you're trading more conservatively, you'll wait for price to trade above that first bar that closes above the 5-period simple moving average, okay? So that's dynamic exit number 2. Let's go to our third and final exit strategy for today, and that's exit strategy number 3, and this is range extensions, okay? If you're a student of mine, I'm sure you're well familiar with what range extensions are, but I see a lot of new names and faces in today's presentation that are not students of mine, so let's give you a brief explanation of range extensions. All right, we're looking at our friendly chart here, FANG. Once again, let's take this point as our entry. We're going to be buying right here, okay, based on some strategy, based on we just think it's maybe breaking out of a short-term downtrend. Whatever the case is, we decide to go long here. If we're going to be applying range extension exits, what you want to do is measure the range of the setup bar. That's the bar that you decide to buy, or where there is a buy signal. In other words, a little green arrow here. And when we say measure the range, we don't mean from open to close. That's not really what a range is. A range is always the extreme high or the top of the wick, if you're looking at candlesticks, to the extreme low or the bottom of the wick. The very top of the bar to the very bottom of the bar. That's what we would call 100%. So let's say this amount is 2 or 3 points, okay? So what you want to do then is add that same amount to where your entry would be at the top of that, let's say, and that's the 200% exit level. Now, we can continue to add that from the 200% exit level, that same amount of points, let's say it's 2 or 3 points, and that will give us the 300%. And we'll continue to do that again, add that same amount of points, and this will give us 400%, and one last time, add it again, and this will give us 500%. So this distance between these levels is the same amount of points right here. That's why we call this 100%, okay? So how do we use these? Well, it all depends what type of a trader you are. If you're the type of trader who likes to get in and out quickly, you don't like to hold your money overnight for a long time, or you're a day trader and just want to have a number of different trades, you don't want to be holding one position all day long, you would most likely exit at the 200%. You would get out quickly and move on to the next thing. If you are a swing trader, if you like to hold it a little bit longer, days or weeks, then you would exit at the 300 or the 400%. And if you're the type of trader that likes to get as much bang for their buck, they want to squeeze out as much profit as possible, then you would exit at the 500% level. If you really studied the stock or the market or the currency pair or whatever you're trading and said, hey, this I believe is really going to have a big move, well, you would exit at the 500 level, okay? Now, there are a number of ways to trade this, though. Let's say you had a couple of 100 shares. Well, what you could do is exit 50 shares here, 50 shares here, 50 shares here, 50 shares here. So at every level, you're getting out of a little. Or what you could do is every time we get up to a certain level, let's say your stop was right here, well, you would move it up to unchanged. Now, when price got up to the 300 level, well, then you'd move it up to 200. If it got up to 400, you move it up 300 and so on. Here's the only thing we recommend using the range extension. We always tell our students, especially in the beginning, to be out of your position entirely at the 500% level. Why? Because we have noticed over time, this is where the trend will usually change. This is where you will want to get out and look back in hindsight and say, gosh, why didn't I exit? I was going to go for the big bucks, and I had a great profit. Once again, the worst feeling in the world that turned into a loss. So we don't want you to get there. So if you're going to be using this type of exit strategy, we always advise our students to get out of everything at the 500% level, at least while you're beginning to use this method and learn how to apply this exit strategy. All right, so let's see how this trade unfolded. Let's say we wanted to get out here. We really did a study of FANG. We really looked at it. We looked at a lot of fundamental news. We looked at everything. It's up to us how we want to trade. And we said, I think this is going to have a big move. So I'm going to exit everything, put my whole position right here at the 500%. Well, as we watched the trade, that was a great decision because in a couple of weeks' time, you got out and you made a nice 25-point gain. It just traded right there. And then look what happened. Okay. This is why we say you should always exit out of your position entirely at the 500% level. It's at least in the beginning while you're learning how to apply this. Okay. Now let's review what we just taught you using exit number 3. This is a fixed exit, obviously, because we have these certain levels where you know exactly where you're going to be getting out. Now you can trade them differently and move them to different levels and get out at one level and get out a portion at another level, but at least you know exactly where your exit points are. That's why this falls more into the fixed exit category. And the way it works is if you're long, first thing you want to do is measure the range of your setup bar. It doesn't matter what strategy or technique you're using. It could be even based on fundamental news. Okay, let's say some good earnings came out. All right, well, the bar that you decide to go long and get into the trade will measure the range from top to bottom, and that will be 100%. And then you simply apply these different levels based on that same amount of points. So measure the range of the setup bar. That's where all the requirements are met for you to buy, and then add it to that same bar's high. These are the range extension exit levels. Now, let's say you want to go short. Let's say your strategy, your system gives you a great sell short signal. We don't mean sell to get out of the trade. That's your exit. We mean to go short, to bet that the market's going to go lower. Well, you do the same thing. You just reverse it. Measure the range of the setup bar from top to bottom, and now you're going to subtract it from the bar's low. These are the range extension exit levels. Now, someone would say, well, Steve, I trade options. I know we have a lot of option traders here. That's okay. If you have an option or some type of spread strategy, all you do is you base your exit off of where the price is telling you. You never base your exit with an option based off what your option's telling you. Base it off of what you are trading. If you're actually, even though you purchased an option or some type of spread, if you're basing that option off of a stock or a future, that's where you make your decisions, what that market does, okay? So there you have it, the 3 exit strategies that will change the way you trade. I've been giving this presentation periodically over the years, and some of our students have gotten back to me telling me how it really helped their trading, because before, most of their exiting was just based off of subjective feeling, something where they'd say, okay, well, I'm going to see if it gets up higher. I just kind of wait and get an idea what the market's going to do. And that, once again, is a recipe for disaster, because how many times have you been in a trade and you feel great, and then you wake up the next day and some news came out, or the market all of a sudden just decided to change its personality and go the opposite direction? It's the worst feeling in the world. So having a proper exit strategy will avoid this unnecessary pain. And you can decide for yourself. My only suggestion is to paper trade with these 3 different exit strategies first and see which ones make you feel the most comfortable. Maybe going in and out of a couple at a time, or all 3, but it's up to you. You have to first get a good feel for them. I know some traders feel much better trading with the 5-period moving average. I know other traders just love the range extensions. So once again, there's no right or wrong. It's what makes you feel comfortable. That is what's really at stake here. Now, unfortunately, a lot of students will say, Steve, this is great, but you know what? That $10,000 method I purchased sucks. It doesn't produce any gains. It's just terrible. I've lost so much money, wasted money off this. And then, the method I'm doing is okay, but it gets me out too early, or I get out too late. I've lost a lot of my profit. So Steve, I really don't have a strategy to trade. I don't feel comfortable with one. Well, here's the special Christmas gift we have for you. There's a special offer, a holiday offer for you. It's called our Secrets of a Stock Exchange Specialist video seminar. Some years ago, I was asked to be the head speaker at a seminar in Colorado. And I spoke for 3 hours when I talked about many more high probability trading edges, like which indicators not to use. I went into the difference between a system versus a strategy. I talked about the #1 chart pattern that you should look for in any strategy that you're trading with, how to be on the right side of the markets. And these are all techniques and methods and edges that you can apply to any market and any time frame. So the good news is The people at the seminar recorded this for us. And so this is what this is. This is 3 hours of trading techniques plus a full strategy. And when I mean a full strategy, I mean a full strategy. You're going to get the entries, the exits, and the stop placements. And you'll know how to apply it and how to look for a trigger in the strategy. This is our strategy number one. You're going to get the complete rules to our strategy number one. And just to go into a little bit of explanation about this, strategy number one is what we call a pullback method. That means it's designed to buy at lower levels and to sell at higher ones. And we teach you exactly what to look for in this 3-hour video. Now, for example, let's look at some recent strategy number one signals so you can see how well this method works. Here's an example in PLTR. Okay, this was coming into November. As you can see, the market was going higher, steadily going higher, but then this happened. So this is why most traders make mistakes and don't really make consistent trades, because they assume the market is doing one thing. For example, you would have thought, well, I guess we're making a downtrend now because we have kind of a doji high right here. We're just about matching these old lows. So we're in a downtrend, right? Well, no, because according to the rules of strategy number one, which you'll learn, we were still in an uptrend. This was just a pullback. Now, pullback is designed to have these high probability setups where you would buy at lower levels. And strategy number one generated 3 buy signals right here at the lows before we've all seen what PLTR has done. Went up 35 points coming into the first week of December. Here's another example. This one's in the Australian dollar for all you currency pair traders here, all right? Once again, on this daily chart, someone would say, well, Steve, obviously it's in a downtrend, but look what happened right here. That chat room that I go to, the guy says, well, we're going higher. Look at, we're making, we just made a new high, and this is the beginning of an uptrend. So you got to get into this, right? Well, not according to strategy number one, because strategy number one says we're not in an uptrend. This is actually a pullback to the upside. What this means, it's a selling opportunity. It's not a buying opportunity, the exact opposite. So our students who are students of strategy number one would have known to sell right here based on a strategy number one signal, and you could have potentially captured 460 pips coming into last week. That's over $4,600 per unit potentially you could have captured, okay? Just based off the strategy number one sell signal. Another example, if you're a currency pair trader, in a 4-hour chart of the Canadian dollar, okay? Going higher, then all of a sudden we start into the downtrend, right? No, that's just a pullback, a buying opportunity. And strategy number one generated 3 buy signals right at the very lows before the 4-hour Canadian dollar went up 300 pips, or close to $3,000 per unit that you could have potentially captured. This was just coming into this past week. And then lastly, we look at IIPR, all right? In a downtrend, but right here, it looks like we're starting to slowly drift back up. It looks like we're getting some composure in this stock, and maybe we're starting to create a little base here with this uptrend, right? Nope, according to strategy number one, this is simply an opportunity to sell. It's a pullback, and 2 signals were generated right here to go short. And look what happened coming into last week. You could have potentially captured 35 points. Now, obviously, the stock gapped down right here based on some bad news or some bad information, an announcement coming out on the stock. Well, strategy number one is not based on any fundamental news or any announcement. It's based on pullbacks, which we teach you this formula on how to identify. So guess what? You're going to get the full rules to this, along with nearly 5 decades of tips, techniques, and methods I've accumulated in this special offer. A year from today, you will have wished you became a member of this course. So here's how to take advantage of our special gift to you. Now, this is 3 hours of trading techniques plus a full strategy. Now, normally this would cost close to $1,000 on the Pro Trader Strategy website. That's what it goes for. Our holiday gift for you is a discount down to $37. Think of it, $37. I can almost guarantee you that most of you just can't go out to lunch to a nice restaurant or just to an average restaurant for less than $30 or $40, even by yourself. Some places you would go to just to get a nice meal and a drink this afternoon, it would cost you close to $50 by yourself. You're with another person, maybe close to $75. For $37, you're going to get upwards of 5 decades of information that's taken me nearly 5 decades to accumulate. plus the complete rules to one of our most consistent pullback methods. That's strategy number 1. This is our holiday gift for all of you attending today's special holiday presentation. So here's how to take advantage of it. Contact my sister site, Pro Trader Strategies. I would highly suggest giving them a call at area code 310-598-6677. They have trading consultants who would be happy to take your $37 discounted order over the phone right now. You can start using it as early as today. You're going to start trading, or at least researching strategy number 1 as early tomorrow on your day off. Now, that link you see at the very bottom is the link that will take you to the info page or the sign up page. It's not a live link, but if you open up your chat box, you see that a live link has been posted on there. You can simply click that on and it will take you to the sign up info page. Okay. I'm going to leave this information up here. If you have any questions, please, now's the time. Just go to your chat box and the little Zoom icon list there, or the question and answer box, and I will answer them. The main thing I want to stress is that this is a ton of information that's yours to keep. It's not something that's going to only last a couple of weeks and then it just kind of disintegrates and you have no more access to it. No, this is always going to be yours, and you can go back and use it as reference as often as you'd like. Okay. Someone's asking, I'm a futures trader. Can we apply this to intraday trading for futures? Sure. Anything that we teach can be applied to all markets, all time frames. And as I always say in my webinars, I trade futures. I trade the E-mini futures. So it makes no difference, absolutely no difference if you're a stock trader that likes to trade daily or weekly bars, if you're a crypto trader, or if you're a currency payer that trades 4-hour charts. I use this on small time frames for trading the E-mini. So it's entirely up to you. You can apply strategy number 1 or all of the different tips and techniques that we teach you in this 3-hour course, okay? Now remember, it's Christmas tomorrow. It's a great holiday to give yourself the gift. Invest in yourself. Spend $37 on yourself. I know you've probably spent an arm and a leg on family and friends. How about giving yourself a little gift for the holidays? $37. That's all it takes. Contact Pro Trader Strategies at 310-598-6677. Okay? If there are no more further questions, I leave you on to your holiday, your one-day holiday, your vacation for the day. As we take one last look at our disclaimer, thank you so much for taking time out of our Christmas Eve presentation to come here and watch this video. I really hope you learned something and you can start using those exiting techniques as early as Thursday if you like, but please paper trade with them first. Okay, as we close, I want to thank you for once again attending on this day. Have a great holiday, a Merry Christmas, and I look forward to seeing you all in the Specialist Trading course. Thank you so much. Have a great holiday. I'll see you later on in the week. Bye-bye.